This episode of the Commercial Real Estate Investor Podcast is brought to you by my CRE Accelerator Mastermind, where you'll get access to my step-by-step investment blueprint, essentially a library of resources on how to invest in commercial real estate. You'll get connected to a supportive community of other commercial real estate investors that are doing projects just like you. You'll get personalized coaching and feedback from me every step of the way. Go to www.crecentral.com to learn more. Welcome back to 30 Deals in 30 Days. Today is day 10. We are 1/3 of the way of underwriting our way across America, doing whatever deals you guys are submitting in the live chat. There have been some interesting ones thus far. I am appreciating all of the lessons learned. Hopefully you guys are having as many takeaways as I am. I mean, I had somebody ask me earlier, how much do you think you learned from doing this? And, honestly, before I started the mastermind and I was analyzing these deals in every market twice a week with everybody in the mastermind, I didn't have the skill set to be able to go through and look at deals in random markets and wrap my mind around that market in a couple of minutes, or wrap my mind around that deal and how it's positioned in the market or compared to comps if I didn't do this all the time. So if you are looking or wondering, how can I get better at underwriting? Do what we're doing right now. Just go underwrite a random deal every day for 30 days, and you're going to make it work really well. You will understand really how all of this works by the end of that, especially if you're underwriting in your market. We're jumping all around the world if the world was just the United States. And because of that, you guys are seeing how I look at and analyze all of these different markets in real time. So it's been a lot of fun doing this with you guys. Today we're going to be diving into a deal from Z in Sugar Land, Texas. I don't know if we've underwritten anything in Texas yet, so we'll have some fun with that. Jam is saying, welcome to day 10 of 30 Deals, 30 Days. You're on the money, Jam. Welcome to day 10. Z is saying, let's go, day 10. Z, we're looking at your deal. Oscar, let's go. All right, guys, let's do this. Let's go. So let's see here. Z is saying, hey, Tyler, I found a property that I came across here in Sugar Land, Texas. It's a value-add property. Occupancy is 5.79%. That's like just a, I don't know, nominal, an honorary lease for a mailbox or something. I drove past this one on the way back from work and saw it was vacant. But there's a similar one up for sale going for $7.6 million. It has 100% occupancy, similar to the other one. It's vacant, going for 4.5. I was wondering if this is a great deal. Let me know what you think. Pythus is saying, James here. Dude, buddy, thanks again for the Tacoma analysis. Might drop another if everyone's got a chance. Absolutely, James. Happy to do it, my friend. Drop those. Anytime you've got a deal, feel free to drop it in the chat, because I'm keeping a running list of every deal that everybody has dropped in the chat, and we're jumping into it from there. So, all right, let's see here. Let's pull up this Crexy listing and look at this vacant property, see what kind of value-add opportunity we have going on here. Oof, I don't know if that's right. Is this maybe not loading right? That's weird. Something doesn't seem to be right on this page. All right. Well, we got the OM anyway. Okay. So looks like it's brand new. Looks like 2 retail buildings next to a bunch of residential, so probably pretty desirable area. Value add opportunity, 2024 construction. So if you see a value add opportunity that was built in 2024, red flags all across the board. I don't know what else to tell you. There's something going on here for sure. That price per square foot, probably a little rosy considering the vacancy, but we will dig into that and see. Surrounding tenants, dense rooftops. Yeah, I mean, it looks like it's in a pretty decent area. That seems like a pretty, just looking at the map, that seems like a bit of a major thoroughfare, right? You got a lot of commercial properties around here, and then just neighborhoods all over. That's what you like to see. Regional map. Sugar Land's it's a suburb of Houston. Is that correct? I'm pretty sure that's right. All right, so you've got Bell Vista Investment USA. What even is that? That sounds like a made-up company. It looks like a made-up company. This is a stock. That's a stock photo. Oh, it's probably the developer. M&A, real estate investments, M&A advisory. Okay, well, that's a little. I love how stock footage instead of a picture of who the principal is. This could be a scam. Interesting. All right, so you've got 17,259 square feet available. I mean, this is brand new, so I don't understand what the problem is here. Their pro forma doesn't even matter. I mean, it's vacant. Oh, look, guys, year one, you're going to make $28,000, but year two, you'll make $493,166 because you can do what we can't. And that's why we need you, buyer. Come save us. What in the world? I love how, like, year two is just zero vacancy. Like, there is no turnover vacancy at all. I mean, obviously, there's nothing to turn over, but just, like, vacancy in general. Oh, sorry. You're what? Losing 6 or 8% vacancy allowance. Okay. Operating expenses are only 25%, 20% of your potential base rent. That seems low, but we'll dig into it. Tenant improvements needs another $670,000 to get tenants moved in. So what's probably happened here is that they might have, Dylan saying present, don't mark me as absent. Ooh, Dylan, you just made the cut, man. Glad you're here. It seems to me like they probably ran out of money. That's probably the biggest thing. They ran out of money and they cannot get this leased because they can't finish the build out. That's what that says to me. We'll see if they straight up say that anywhere else. Nope, doesn't look like it. This is definitely one of those groups, by the way, that if they see this video, they're going to send me a cease and desist. I don't know why. I get that feeling. There's something wrong with this Crexy page. I don't know why that's not working. I don't know. I got to say, my red flags are waving. There's something sketchy going on here. Let's look at the area. So it looks like, is this maybe the spot? No. It could be. Sometimes you never know. You get to these. Yeah, it could be. Yeah, that looks like similar construction. I mean, that's got to be it. So it looks like they built it in phases. I wonder what that gas station is. That must not be a part of this, maybe? This is interesting. I wonder, I don't know what's happening there. Sorry, guys. If the gas station built all of this, and then they're just trying to sell that now. Because look at that. The gas station has a very similar design. See, it has the same ridge cap there. So it's probably the owner of this gas station just bought all of this, built it all, and maybe doesn't want to deal with it. But I don't know why you would get within 600. Like, that's a lot of money to spend to not want to spend the 600 grand to build it out. It looks like pretty standard construction. The shop's at Belfort. Jordan Belfort. All right. I don't know. This is odd. Something's not right here, and I don't know what it is. Let's Google this address and see if anything else comes up. Not going to do that. Okay, here's the leasing flyer. Interesting. Let's see why the leasing team can't figure it out. Suites ranging from 1,200 to 10,000 square feet, 110 parking spaces. It's got a solid parking ratio. Lots of vehicles per day. Freestanding buildings available at 6,600 and 10,505 square feet. Contact broker for more information because they don't want to share the lease rate. Maybe they're asking too high of a lease rate. Because you look at like the demographics, you're like, yeah, well, this makes sense. The population's strong. The average household income is strong. Daytime pop, within a 2-mile radius is low, but within 5 miles is high, right? But that makes sense because you're in the residential area, right? You're not in the business district. I see his thing. I gave you a hard one here, I guess. I mean, it's just interesting. Like I'm looking at this, I'm like, I can't figure out what the deal is. Like something doesn't seem right. So yeah, okay, it's all one project. So the C stores here. That's a very strange access right there. But it really looks like they probably built this, bought this for the convenience store. And then they're just, selling it off. Coast Ironwood is saying CoStar shows it's both buildings gas station too. Interesting. Coming soon. I just can't stop thinking about this website. My journey in this industry began alongside my brother, who's a seasoned contractor. I love that. Like, we want to make this so personal, but I'm not going to tell you who I am. I'm not going to share my name. I'm not going to share my face. We're going to hide all of this. And that's kind of odd. Like, that is, like, this, when I said this is stock image, this is literally like when you create a website and you go to stock images and you type in real estate, like that image is what shows up. I wonder if I can reverse search. Yeah, search this image with Google. It's going to be everywhere. It is like one of the most prolific images of all time. Look at that. Joliet Avenue, Lubbock, Texas. Oh, maybe that's like the actual house. That's funny. Okay. I mean, I've got nothing on these guys. Let's look at the other deal that you were looking at, Z, and see if we can compare it to it. Man, something must be going on with my Crexy. Or something must be going on with the links you sent me, Z. I don't know what's happening here. But at least we got some OMs. All right, Monarch Capital Advisors. I mean, first off, right off the bat, this shopping center looks better. That's one of those things that's like, at first you can't really say why. But if you look at like the texture of the storefront, like it just looks so much more dynamic. Whereas this is kind of plain. It's not bad by any means. But that right there shows you the difference in architecture. Like who you hire and how you design these projects matters. This to me is that sells it right there. That's a great looking picture. Got some great tenants in it too. I mean, these are all, you got some, what looks like local and regional guys mixed in with some, maybe franchisees. $7.6 million, 6.65% cap rate. Actually, let's see how far this property is. From Sugarland. I want to see how much of, that didn't work out. How much of a comp this really is. Rosenberg, Texas. Okay, so we're not too far away, right down the street. This looks like it's maybe the next suburb. Okay, so and further out of town. Could be a good or bad thing. It's on the water. That's nice, but maybe we have to worry about flood insurance. So they're asking $386 a foot compared to the $260 that the other group is asking, which makes sense. I mean, on a vacant building like that, you're not going to be able to get a cap rate. There's not. It's going on a price per square foot. But $260 just seems aggressive to me. I don't know the area though, so I mean, that could be part of it. But like for vacant retail, that's not like clearly Class A, in primo area, which just doesn't seem to be. I mean, it seems like a good area for sure. I'm talking about this other one. Sorry. It seems like a good area for sure, but I mean, you don't look at this and go, well, hell yeah, that's Class A. Like that's the nicest retail. I mean, you don't this one either. I'm just saying. They've even got some debt terms for you. That's always nice. Some good commercial real estate brokers will go out there and they'll source some debt for you because they know that that's what it's going to take to get it done. Okay, look at this. They're saying their total operating expenses are $13 a foot, so $12.92 a square foot. I'm going to write that down because if this is a comp, then that's a pretty good number to have, right? $12.92 OpEx. See, and if you're trying to underwrite deals like this is what you do. You go and find similar properties that actually have a full offer memorandum like this. Typically not too hard to find. I mean, of course, you'd have to agree with this. Look at those property taxes. This is why I can't invest in Texas. I can. We are doing deals in Texas. We're working on one right now. But, damn, that is a high property tax for what this is. Okay, this tenant, and this is the cool thing, too. You get all the tenant's lease terms. Domino's signed a 10-year deal at $28 a foot net. All right. Ooh. Look at that. It's flat for 10 years. Not the worst thing in the world, but it's flat for 10 years. Goes up 7% in their first option, then 6% in the next option. Let's see, the cleaners, $26 a foot. That also looks flat for 5 years. I wonder what they're doing here. $29, flat for 10 years. Oh, okay. I see what they're doing. This is the full term, and then they're putting in when they actually increase. I was like, man, who is signing leases like this? This is a really confusing way of laying this out. I wouldn't do this. Because that looks like this is the full term. I don't know. It's just odd. Maybe this is flat. Because look, it says option 1 right after that. So that means that, their option, these are flat. Oh, that's weird. I don't like that. I mean, if you're going to sign these longer-term leases, I like to at least see something that's going to roll with the consumer price index because the value of the dollar is going to go down. Yeah, Z's saying, I was confused. Yeah, it's not very easy to follow really what they've got going on here, honestly. Which is fine. Whatever. We don't necessarily need that. $28 a foot, $26 a foot, $25 a foot. 22, 27, 23. So we're really probably, say, 23 to $26 a foot is what I would argue. Is probably the triple net price. They probably gave these guys some decent TI. I mean, you've got some really good brands in here. This is a great OM, by the way. If you want to learn how to market your property for sale to the next guy, go download this offering memorandum. It's a good one. Because it keeps giving us more context. You know, some OMs, you just never really get the grasp of the property, but this one I feel like I pretty well understand it. The 5-year, 10-year flat terms, however, not a fan of that. But that actually does make it slightly easier to underwrite. We'll just say, we don't have any annual increases with our comp. Okay. Well, that's interesting. I mean, that looks substantially different than this one. I don't understand this occupancy. Like, that's not, I know it's the investment group, but like, why would they sign a lease? And why would they occupy that? And then show that they are occupying 5.79%. Like, what's the point? What did we say this was? About 16,000 square feet. So they have in here that their operating expenses would be $142,000 a year. 142,000 divided by 16,000 square feet. It's only $8.90 a foot. And we had $12.90 a foot on the comp. So they're probably $4 a foot. Remember when I was like, it seems like it's only 20 or 25% of the gross potential revenue. That seems kind of low. If it's triple net, it doesn't matter to you on your bottom line. But it does matter to the tenant because they're going to be looking at their all-in cost, right? So if we're able to get our operating expenses down to $8.90 a foot, that means I can raise my base rent compared to the other property by $4 because the market is, X minus, whatever the OpEx is, right? So if I'm able to go in and, lower my operating expenses by $4 a foot, theoretically, I should be able to raise my base rent by $4 a foot and increase my net, right? I have a feeling though that it's just not going to happen at $8.90 a foot. If the other one is open operating, has clearly been going for a while, they actually have historical data. This one is based on an idea. So I would use the other numbers compared to this. So let's say, let's get into our underwriting. Let's see what we can do with this puppy. So let's get the exact square footage on it. Oh, come on. You're going to break it up. You're going to make me do math again. All right. We're at 6671 plus 10,588. That's 17,259. This is Z's deal. Sugarland. All right. So square footage is 17,259. We're buying it for, let's say, 4.5. Yeah, $4.5 million. Whoops. They're estimating another $600,000 in TI is what it looks like to get it up to where tenants are going to take it. See right here, it says $144,000 in leasing commissions and $670,000 in TI. I'm going to run the math on that. So 670 divided by 17,200, just round numbers. $38 a foot. That's probably a realistic number. I actually appreciate that. So we'll say we'll bring $670,000 in capitalized rehab. The reason I say that that's realistic, like I don't know, I haven't seen the condition of the space, but if it's in a cold, dark shell, $40 will go a long way, especially if you just say to a tenant, hey, we'll put up a demising wall and we'll give you, $35 a foot for the rest of your build out. You can kind of handle that in a different way. So Jam is saying the world would be a different place if they taught this in school. You know what, Jam? Even better. They didn't teach it in school, so all of the kids that you went to school with aren't competing with you now. That's another good way to look at it. Christian is saying, what about rent concessions, free rent? It's a good question. I would assume that we're going to have to give some free rent, and I'm probably just going to include that in my occupancy leading up to this deal. Closing costs, probably what, 60 grand? Not 600,000. That would be a problem. It'll probably be more than that. Let's just say 80,000. I like to keep that closer to 2%, but on these bigger deals, it'll start to go down a little bit. Right, so, okay, 25% down, 7% interest, 20-year amortization. That's reasonable. Let's start off at $25 a foot net. I think that we could argue that. With 0 increases, it's going to stay the same every year. So coming over here to our occupancy. You know what's funny? The way that this vacancy rate is set up is exactly how their pro forma looks. 100% vacant year one, 93% occupied year two. I think that we'll get to maybe 50% occupancy. Let's say 75%. We're not going to lease up very much. But there's something going on there. I don't know why, but apparently the team that they've got working on it can't get it leased up either. Let's say 25% and then 7%. I'm being conservative here because something seems a little fishy with this deal. I will keep it at $1 a square foot, 6% leasing commissions. I'm keeping the expense increases at 3% because regardless of whether your rent goes up 3% per year, your expenses will. It's a triple net lease, so they're not going to matter. But as far as like my asset level expenses, that'll still go up. That is why it's important to have rent increases. It never recovers and gets better. So we never get a debt service coverage ratio that makes sense on this deal. Even if I have 12 months interest only, let's say I've raised capital for it, right? Charging 2%, 35 cents a foot. I think that's fair in reserves. Taking 30%. Look at that. My investor's cash flow. I don't know about you, but I don't have investors that would say, hell yeah, take my money for a 0.31% return in year 5. Not good. You know what we will do, though, is we will throw the cap rate on here that this other one is asking because that should be a good comp. So what are they asking? .65%. Very specific. I don't know where those numbers just went, but it wasn't in the box that I tried to put it in. Let's undo that just in case. Never know. All right, 6.65. After 93% net refi and sale proceeds, the reason it's set to that's 6% commissions and 1% closing costs. So you'll see that when you pull these spreadsheets up. I've got some notes in here for different things. Oh, hey, you're not losing money. That's about all you can say. You're not losing money. All right. Let's look at what the blended rate was for this deal. So their pro forma says annual rent of $504,000. So this is going to give us the average rate across the whole property. So that'll be a more accurate number than my $25 a foot. $504,000 divided by 19,633. I got bad news, guys. It's only 67 cents a square foot more. It's $25.67 where that came in at. That's kind of funny. Boom. Oh, we broke the bank. Here's the returns. Just kidding. It's not going to do anything. Oh, actually, it doubled our returns in year 5. More than. Remember, we were at 0.31%. Now we're at 0.78. I'm liking this deal now. We've already doubled our returns. Z is saying, thank you for underwriting this. Yeah, absolutely. This stuff's fun. Like, I genuinely enjoy this because you learn something from every single deal you underwrite. Like, seriously, I learn too. Like, Christian is saying, do you think those TIs are high enough? I feel like they're way off. If they're way off, it could destroy the numbers. I mean, Christian, it's hard to say. What I would say is they're probably right on the money based on the rental rates in the area. Like, what you generally don't see is your tenant improvement allowances be substantially higher than your rents. If my rents are averaging $25.67 a square foot, I'm not going to expect to have to give out $50 a foot in TI. Now, it depends on the condition of the property. Like, if it's a cold, dark shell or worse, I don't know. I mean, it looks like from this, it's not in, completely barren condition because the outside's pretty finished, but they show zero pictures of the interior, which I do not appreciate. Like, if you're going to try and tell me to underwrite a deal and you're not going to show me what the interior looks like, what the hell am I supposed to do with that, right? I mean, and clearly there's a tenant in here somewhere. Maybe they're occupying the end cap. I have no clue. So I would say $38, $39 a foot is probably good. Generally, $5 to $10 a foot more than the first year's rent is probably a good metric to just have in the back of your mind. Now, it depends on the space. Like, second generation, it could be less than the first year's rent. It could be $5 to $10 a foot less. So, like, if we're renting it for $25 a foot, it's already built out. You might give TI of like $15 to $20 a foot, right? And if you're going for like a badass restaurant, or a dental office, they're just expensive to build out. You might have to give 75, 100 plus bucks a foot in TI. But they'll also sign a 10-year lease, and they have outstanding credit, and they're going to invest about as much as you are. So it just depends. Really, really depends. So, I mean, here's the thing. Even at net 2567, it doesn't work. So remember when I said 261 is too high? I think it's probably worth closer to $200 a foot. So what does that put us at? 3.5? Returns are getting there. Not great, but look at that. Since it's still a development, like, we make 63% on our money. Not great, not bad, right? So now we've got to come back in here and look at it some more. I mean, I would say, do we think we can get $26 a foot average? No, I'm not going to mess with my rents because this other deal that's right down the street is a really, really good comp. They've got some really great tenants. They've got a good-looking building. Looks like it's newer construction. They've set the market. Like, the market is what it is. I'm not going to be able to get any lower expenses. We're already triple net. I mean, the only other thing that I can continue to do is offer them less. Now, typically what I want to do is I want to get to a point where I can achieve at least a 2 times equity multiple over 5 years for my investors. I want to double my investors' money every 5 years. Typically, we outperform that with our investments. So if you ever want to invest in real estate, reach out, tylercauble.com/invest. But, oh man, we're still not getting there. This is just, it's not like, at this point, the only lever that we can pull is if we start giving ourselves less as the GP, which I wouldn't do. Like, if you're not going to be super motivated to get out of bed and make this deal happen, your investors are going to lose anyway. You do hit your debt service coverage ratio, but why is the sale price just not getting to where we need it to be to make this a killer deal? It's just not happening. I mean, it's at a 6.65% cap rate. see the value's just not getting to where it needs to be based on what's actually coming in. J63 and A99. Yeah, so see our net income, 392,601. It's just not getting us there. If we did add back in our 3% annual increases, though, I think it'll finally push it over the line. Look at that. See, that's it. Geez. Like, I just want to point out to you guys how important it is that you have 3% annual increases in your leases. Don't ever do anything flat. Look at this. Right now, with 3% annual increases, we're looking at a 118% return, right? A 23% annualized return for our investors. I'm going to go back to making that flat so that you guys can see the difference. $82% with a 16% annualized return. We were just at 23. We're talking about a difference of 7%. That's 50%. A 50% difference on your returns to your investors by having a 3% annual increase in the rents. That is how important little things like that are. Isn't that crazy? Like, it just compounds so much over 5 years. It totally swings this from being a terrible deal into a decent one, right? So now we know we have to keep 3% annual increases. And the math works at $3,250,000. The building's worth $3,250,000. $188 a foot, which is about what I would expect, right? So for you to go out and buy land and build a flex building, you're typically going to be at $110 to $130 a foot, depending on what you build. So for retail, which is going to be a step further, you're probably going to be able to deliver that for $150 to $180 a foot, right? Not far off from right here. Well, they've already taken a lot of the work out of it, right? So they're going to be able to get a premium for selling that. So they've got margin in it at $188 a foot. And if they don't, then they built this wrong and should not have ever done this deal. But if I was them and I got a $3,250,000 offer, I would take that yesterday, because that's what this property's worth. And if they could sit down and go through, like, and I'll do this too, because I have, like Chris, one of the members of our mastermind, asked me the other day, he's like, so like once you underwrite like this, how do you just make an offer that's $1,250,000 less than what the owner is asking? Well, I'll sit down with him and present him my underwriting. Like, look, here's everything that I've done. Are there any assumptions in here that you think are crazy? I'm putting down 25%. My interest rate is 7%. My term is 20 years. This is the average rent that I think that we'll get on this property. I'm doing triple net, so we don't even really have expenses to worry about, right? I mean, you go through all of this with them and be like, we don't even start cash flowing until year 3. Now, they might argue, oh, well, your vacancy is low, your vacancy's low. Well, you haven't proven to me that the market can really lease up strongly here, because you've had it for leased. You've had it for leased. You have had it listed for lease, and you haven't gone anywhere with it. So I don't know. Z is saying, come in and lowball it at 1.2. Hey, couldn't hurt. That'll make your 3.25 compromise look a lot better. Jam is saying, love the sigh of relief when you added the increase. Yeah, you know what? It feels good when a deal works. It feels good. I mean, we don't want to manipulate numbers to make a deal work, but like, that makes sense. I can easily add into my leasing program, we will not sign a lease that doesn't have 3% annual increases. Not going to happen, right? So that's how you make this deal work. Like a deal like this, I would actually back into like, okay, how are we going to make this work? So, there's so many different ways to underwrite these deals. There's one, like based on comps, but two, this is kind of a special case. let's go out. We've got the rent. We've got the operating expenses. We've got, X, Y, and Z. We've got all the data, basically. Now we just need to back into the purchase price that we can offer. I wouldn't start at $3,250,000 for my offer. I would offer them $3 million. And I would go up to $3,250,000. I wouldn't go above that. Like that is we just determined our MAU, our maximum allowable offer on this property. So anything you can get it below $3,250,000 for, you're just, icing on the cake. You know what I mean? So Z's saying this is gold information. Thank you, Tyler. Absolutely. Game Master, what's going on, dude? Good to see you in here, man. It's been a bit. Yeah, we're, well, I know you're saying Sweet caught the live, but unfortunately, we're basically wrapping up the live because we kind of finished, I guess, everything that we need to do here. So there you have it. I mean, that's what I would do on a deal like this. It's a very interesting deal. I like opportunities like this because there's not a whole lot of variables. I mean, the building's built, so you don't have to worry about construction. It's just, let's get it leased up and will this work? So I think these are great deals for y'all to look at because it takes out, some of the things that can go wrong by having that. So appreciate you guys for joining me today for day 10. Just like what Game Master said, don't forget to hit the like button. Appreciate you guys for being here. Happy Halloween. Be safe. Have fun tonight. I'm headed to a haunted house. I'll see y'all tomorrow. This episode of the Commercial Real Estate Investor Podcast is brought to you by my CRE Accelerator Mastermind, where you'll get access to my step-by-step investment blueprint, essentially a library of resources on how to invest in commercial real estate. You'll get connected to a supportive community of other commercial real estate investors that are doing projects just like you. And you'll get personalized coaching and feedback from me every step of the way. Go to www.crecentral.com to learn more.